FTAs, Unlocking Investment Opportunities for Growth. On 2nd April 2025, the US announced tariffs on countries, which created a furor. And from there, the race to create free trade agreements between individual countries and the US started. So, what are really free trade agreements? Free trade agreements are essentially strategic tools that are used between governments to increase trade. And very often, there can be big benefits of good trade agreements. For example, if you go back and look at history, you'll find two trade agreements had very, very powerful benefits that came out to countries that entered into them. One was Vietnam, where the free trade agreement with China actually resulted in growth, which used to be much lower, starting to move up to 5% every year for Vietnam. And finally, by the time you reach 2070, it was at about 6.8%. If you look at the free trade agreement that came up in North America, where US, Canada, Mexico were a part of it, you found a lot of companies investing very heavily into Mexico. And what it ended up doing is a lot of foreign direct investment went into Mexico, helping the growth of Mexico as a geography. The benefit of free trade agreements are that you could end up becoming a part of the supply chain in certain areas. And when you become a part of the supply chain, there's a lot of foreign direct investment that could come in. And as you're probably aware, FDI is looked upon as much more stable sources of capital as compared to other sources. What could also happen is there could be certain industries that benefit disproportionately from free trade agreements, depending on the kind of geography that the agreement is entered into. So typically, sectors like textiles, auto components, electronics, these are all examples of areas which benefit significantly, typically when there are free trade agreements. In fact, India has just entered into one with the UK as well. And the expectation is that the size of that agreement will result in, by 2040, having about $34 billion of trade between India and the UK. So what would you do with your investment portfolio as a result of all this? If you look at free trade agreements, one of the benefits that can come to you is you could look at which of those sectors could potentially benefit from a free trade agreement and try to see whether it makes tactical sense for you to thematically go into those spaces or look at sectoral opportunities in that particular space. At the same time, there may be certain sectors that do not benefit from a free trade agreement, and you could actually manage risk in your portfolio by moving away from some of those sectors. The other thing is that if the free trade agreements are being done with large countries where there is a large amount of trade, there could actually be a GDP impetus that comes through with free trade agreements. And because of that impetus, you could actually end up seeing that growth increases. And as a result of that, for you as an investor, taking a long-term view starts to become more attractive. I think over the next few months, there will be a lot more activity around free trade agreements, and we will be watching the space carefully to see if there are opportunities that are getting created as a result of the same.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of Basel and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory. This material is for information and educational purposes only.